Hey there, welcome to Be the Boss of Your Money. This is the place that you turn to for personal finance, investing, credit, debt management, risk management. We talk about it all here. This is called Be the Boss of Your Money. It's really about you taking control of your money and making the best possible financial decisions to improve your life, your future, and for your family. That's what this show is all about. Today is special, and our special is the Dow 30 stocks. What's going on? With the Dow and the S&P and the NASDAQ at or near records, I think we need to evaluate how we think about each stocks in general, so that you could make the best decisions for you. Let's get into it. We're going to just quickly roll the intro, and then we are going to have a great show. We've got a lot of ground to cover, so here we go. Welcome back, everybody. My name is Mitch Goldberg, your host of Be the Boss of Your Money. This is a show about personal finance. We dive in deep into all topics of personal finance, from credit cards to asset management, financial planning, passive income, and so much more. Today, I want to focus on the Dow 30 stocks because this is the big thing now. This is on the tip of everybody's tongue. The stock market, it's gone up so much. It has confounded so many people that in the last year, we've gone from here to all the way, I have to switch cameras, to all the way up here. And people want to know, what should their next move be? I want to give you a way to think about investing. Stock selection. And we're talking about individual stocks, but this could certainly apply to individual, to the sectors of the market as well, not just individual stocks. I want you to walk away from this with the thinking, yeah, that could work. That might not work depending on the environment. Now, this is not to say you should get bulled up on the stocks we're talking about. This is to say that you have to pick your direction. My base case has always been, for the last year, that we would see a substantial economic rebound in the second half of 2021. Well, I was wrong, because it's happening now. It's been happening for the last few months, and it's accelerating. And it's helped lift the Dow, the S&P, and the NASDAQ to near or at near records. So for the first quarter, which just ended at 4 o'clock, so about 40 minutes ago from the time I am doing this live stream, for the year and for the quarter, the Dow up 7.8% year to date. That's pretty darn good. S&P up 5.8% and NASDAQ trailing up 2.8%. It's odd that the NASDAQ trails, you might think, but that just plays into the hands of what we're going to talk about. Economic recovery, work from home stocks are sinking, reopening stocks are rising. That's been basically the theme for the first quarter, and rising rates, which really reflects the economy opening. So if you're watching this in the live stream, I greatly appreciate your time. I know your time is very valuable. It's precious. And the fact that you chose to spend a few minutes of it with me means a lot to me. Thank you. If you have any questions, hit me up in the comments. If you have words of wisdom, words of encouragement, those are always appreciated as well. If you're watching this in the live stream, welcome to you as well. If you have any questions, you know what to do. Hit me up in the comments. I'll see the questions and I'll reply back to you. Watch this in the replay as if you were watching the live stream. So we've got somebody out there. Just a quick hello. GG. Gary is out there. Hey, Mitch, love your show. I am your biggest fan. You know, I think you are my biggest fan and my favorite fan. Oh, yeah. My favorite fan. Hold on. That's for you, buddy. All right. So glad you could be with me today, and let's roll with it. So we're going to do a share screen, and I'm going to be doing a share screen a lot. I'm going to fly through the Dow 30 stocks, what I mean, what I'm thinking of. So this is it. If you believe the economy is reopening, then you want economically sensitive stocks. That's financials, industrials, which are trading the XLI, the industrial ETF, is trading right at its all-time high. Energy, consumer discretionary. Consumer discretionary are things that consumers buy that they want, not necessarily need. Like Tiffany and Harley Davidson are examples of consumer discretionary. And Procter and Gamble, and let's say Conagra Foods are considered consumer staples. They make things you need. So let's get into this. So this is not to say you should buy this stock or that stock. I want to be clear. It's to say if you have a point of view that says the economy is picking up, reopening, then you want to look at those stocks and you want to be able to identify those stocks. If the economy is going to shut down again, and we have new COVID variants that are spreading all over the place, and it slows the reopening down, scares consumers into running back into their houses. People stop flying. Then you want to know which stocks benefit from that scenario, which would be, again, the consumer staples, work from home, and a lot of the tech stocks. So we're going to go through these 30 stocks. I like this because you've heard of all of these stocks. I am familiar with all of the Dow 30 stocks just because I've been following this index so closely. I've been in the industry for over 30 years, and the Dow Jones Industrial Average is the most recognized stock market index in the world. By the way, you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. So let's do a share screen. I'll put myself up here in the corner. Okay, here I am up in the corner. First, just some housekeeping. The $10,200 unemployment tax break. Okay, if you collected unemployment last year, the first $10,200 is tax-free. Okay, that's the federal unemployment. So federal tax will be waived on that. Instead of you having to send in a revised tax return, an amendment, the IRS said that they will take care of it on their end, and starting in May, they will start to send money back to you if you paid your taxes on that money. As far as what you're supposed to do now, from what I understand, you're still supposed to pay the taxes on the money, and then the IRS will refund to you what they said they would send to you, what they owe you. Okay, so good luck with that. Let me know how you do. And now let's get into the heart of the matter. All right, I don't know how I'm going to do this in the next 22 minutes, but let's start. 30 stocks in the Dow. There's the reopening, economically sensitive. There's the stay-at-home, work-from-home, economic shutdown. And then there are companies that fit into both columns. So we need to take a look at each one. First one, 3M. I think that is a reopening play. The stock has moved up pretty substantially in the last couple of months. To me, 3M, though, is more industrial reopening. They have a big healthcare business. I get that. But in this case, I look at them more as a reopening business. American Express, that stock has moved up a lot because people are anticipating the reopening business. So that is a good one. So there's the reopening play. American Express, it's a financial. The stock has moved up tremendously. It's backed off a little bit today. Not a big deal. You know, today financials actually backed off a little bit, but we'll talk more about that. American Express, definitely reopening. Amgen. Amgen is tough. Actually, I don't think it's that tough. Amgen is more stay-at-home, work from home. Even though you don't use Amgen drugs to stay at home for entertainment or to work from home, it is healthcare. And healthcare is considered impervious to the vagaries of the economic cycle. So that's a healthcare stock. So I'm going to say that stays in the shutdown, economic slowdown column. Apple. Apple is a tough one. I think Apple is really both. First of all, your gateway to the outside world is your iPhone or your iPad, which I have right here. That's how I'm able to do things like this. Okay. So I think that your iPad, your iPhone, those are the gateway to staying at home. But Apple's getting into business and services. I don't think we're going totally back to the way we were in 2019. And Apple still has an incredible hardware business. It's not peak hardware for them right now, peak cycle. They already came out with the iPhone 12. But I do think Apple fits the bill of secular growth with a cyclical bent that if the economy picks up, they sell more products, more services, and they have a huge cash hoard, which maybe they could make a little bit more interest on. Boeing is definitely reopening economic strength. They just received an order from Southwest Airlines, 100 MAX jets, the 7 Series MAX jets. Southwest Airlines has always been 100% 7 Series Boeing planes, and them buying 100 MAX jets is a huge vote of confidence for Boeing. And I think Boeing's order book, which has shrunk, is going to expand pretty rapidly. And now that people are flying again and airlines want to get their planes again and more fuel efficient planes, et cetera, Boeing reopening. Caterpillar. By the way, Boeing was over $400 a share before the pandemic. They had the problems with the 2 jets that crashed. I'm very unhappy with this to even talk about it when I say Boeing is a reopening play. But they have fixed the problems with the planes. Caterpillar. You have to think of it this way. When I talk about any of these stocks, they're reflation or they're stay at home or they're both. Now, we've got an announcement today. President Biden laid out not the most detailed view, but a pretty detailed look at his $2 trillion infrastructure portfolio. The fighting over the money is already starting. It's the biggest infrastructure play amount spent in decades, funded by raising taxes on people who make over $400,000 a year and by raising the corporate tax rate from 21 to 28%. There's word that maybe they'll wiggle down to 25%. And they also want to have a minimum tax on American corporations that do business overseas, something in the order of 20 or 21%. The minimum now is 10%. Biden wants that to be raised to about 21%. Now, this could spark inflation along with the stimulus package that just passed and the 2 stimulus packages before that. So we don't really know if infrastructure plays and reopening plays are going to keep going or if they've moved up so much that the good news is factored into them. I have my own opinion of where things go, but we have to take a look at the downside also. And I want to make sure that you are picking these stocks based on your point of view of strength and reopening or weakness and shutting down again in the economy. So Caterpillar is definitely a reopening play. Chevron is a reopening play. I follow some charts from the transportation, the TSA, Transportation Safety Administration. And you take a look at that. Gasoline use is moving up big. The number of people who are flying is moving up big. So Chevron, definitely reopening play. And you see how the price of gas at the pump is going up. And that is because demand is going up after a time period when oil producers shut down and lowered production. Let's move on. Cisco. Cisco's tough. Cisco, I feel like, has been dead money for so many years. Yeah, it's been in the high 20s. It's been higher than where it is now, not much higher than where it is now. But I'm going to say Cisco is reopening. Big appliances that corporations, when corporations spend a lot of money on technology, they buy from Cisco. So I say Cisco's reopening. Coca-Cola, it's a secular growth consumer staple. So I'll say work from home, stay at home. And even though it's not necessarily helping you work from home, they make products, particularly soda, and soda sales don't really change if the economy gets stronger or weaker. And when the economy gets weaker, investors value a company whose earnings can grow steadily, even if it's very low, steady growth. And that is definitely Coca-Cola. But if the economy is surging, it's an opportunity for cyclical, economically reopening stocks, these companies, for them to make a lot more money. Then people will sell Coca-Cola because they want to be in something that can deliver faster growth at the moment. Dow. Here's the thing with Dow. Dow Chemical is definitely reopening infrastructure and economy reopening, major chemical company. The thing you have to watch out for Dow is input costs. If Dow's biggest input cost is actually petroleum. So if petroleum goes up in price, it makes, and if Dow can't raise its prices to its end consumers, which is basically corporate clients, then that could put a really big squeeze on Dow's margins. And that's why it's so hard to trade stocks like chemical companies, because they are so economically sensitive, but they're also very sensitive to inflation. So if they can't raise their prices while their input cost, petroleum, is going up, that could be an issue, but it is nonetheless reopening play. Goldman Sachs. Goldman Sachs, to me, reopening play. Goldman Sachs has already demonstrated that it is a winner. Look at how the stock has done. Yeah, I know it's off $5 today, but the stock is up tremendously over the last couple of months. They're very big in their investment banking, wealth management. They make more money on net interest margin, on spread. So as long-term rates keep going up and short-term rates stay lower or continue to stay at or near zero, that is very good for Goldman's net interest margin. So Goldman, definitely a reopening play. Home Depot has been a great stay-at-home play because home sales have been doing great. People have to be home. Millennials are buying houses like crazy. People are moving from the city into the burbs. They want a house. They want a house with separate room for each child. They want a house that has a separate home office. They want a house with a gym. They want a backyard. They want more space, and they can work remote. They don't have to commute as much to the big cities. It's not just a New York City thing. This is a nationwide. All big cities have seen the suburbs rise in price, suburban housing. So Home Depot has been a stay-at-home work-from-home stock, but it's also a reopening play because when people have more jobs, when jobs become more plentiful, people also can still buy houses and they still want to spend money in their houses. So I think Home Depot it's in the both column. Honeywell, to me, it's as cyclical as you get, super high quality industrial stock. So Honeywell is reopening. Intel is tough to call. Intel has been a sloth for so long, but they've got a new guy running the company. They are going to spend money and open up new semiconductor foundries in the United States. I'm going to say Intel is reopening. I think their main customers are corporate clients. So I'm going to say they're reopening. IBM, reopening play. IBM just doesn't sell to consumers. IBM's revenues have been shrinking for years. It's just like every time you get excited about IBM and you decide, I'm going to stick my toe in the water and buy a little IBM, your toe gets chopped off. And how many more toes can you lose? So reopening play, though. Johnson & Johnson, stay at home, work from home play, not because they're making technology so you could watch Netflix shows, whatever. It's one of the key vaccine players, that's for sure. But don't buy Johnson & Johnson for a vaccine. You own Johnson & Johnson because it's a great company. The vaccine component for COVID is really just a tiny part of what Johnson & Johnson does. Johnson & Johnson is a steady Eddie growth company. And when the economy gets weak, investors put a higher value on steady Eddie growth because that's where they can get some growth. And when the economy picks up, people want to shift out of those companies and get into companies that are cyclical because cyclical companies will start to show a quick earnings growth. So I think Johnson & Johnson is stay at home, work from home. JP Morgan, in my opinion, the best managed bank in the world. They completely avoided that whole Archegos hedge fund that blew up last week. Excellent risk management, the best of the best. They've got the wealth management. They do some investment banking, but what they really have going for them is net interest margins. Again, the Federal Reserve has said we're going to keep interest rates super low at or near zero, while the 10-year Treasury has risen to a little over 1.7%. The difference between that short-term rate and that long-term rate is huge. It is huge. And that is the most incredible thing for net interest margins. So that's great for banks. So when the economy heats up or when it's expected to heat up, interest rate, long-term rates go up, short-term rates have been staying down. That's very good for a company like JP Morgan. So JP Morgan, economically sensitive, reopening play. Let's go on. Now let's take a look at McDonald's. I think McDonald's could be both. I mean, it's stay at home, work from home because McDonald's stayed open throughout the entire pandemic. And it's a restaurant that is a survivor. You know, so many restaurants disappeared, but McDonald's, you know, they stayed in business. They made things work. And I think when people have more money and they go out more, they'll still go to McDonald's. They'll probably go to McDonald's even more. And now that there are fewer food options available, maybe McDonald's can capture even more market share. So I think McDonald's is both. Merck, same as Johnson & Johnson, steady growth company, dependable, and that is very highly valued in a recession, in a weak economy, in a shutdown economy. But when the economy picks up, people don't want the drug stocks necessarily. They want to own economically sensitive stocks. So Merck is definitely stay at home. It depends on your point of view. Now, some of you out there are thinking we're going back into a shutdown, and some of you are thinking we're going into an economic reopening. I told you my base case. I think we're reopening in the second half of 2021, and then I moved it to now. So I think it's reopening, and I don't think anything is going to stop it. And if you take a look at the number of people vaccinated, something like 50% of all people over the age of 70 in this country are fully vaccinated. Something like almost 25% of all American adults have gotten at least one shot. I mean, and the one dose from Johnson & Johnson means you're done. And the one dose from Pfizer and Moderna means you're pretty much as done as the Johnson & Johnson shot. So it's really incredible how quickly now this vaccination program is rolling out. Microsoft is both to me. Microsoft has done very well, you know, throughout the pandemic time. It went down with the rest of the market last March, a year ago, and it was one of the first to come out of it. You know, Microsoft, Facebook, Amazon, Apple, Netflix, Google. Microsoft is both because they have a huge corporate business and they're great for work from home, stay at home because everybody depended on their computing power. So they're both. Nike, I'm going to say, you know, it's a tough one. And Nike's up a lot. They're having trouble in China because 6 months ago or so, they spoke out how they're against sweatshops and they're against forced labor and how they're against China, what they're doing. I forget the name of the Muslim minority in China, which is awful what they're doing. They're basically putting these people into, concentration camps and like trying to change their minds, brainwashing. It's really sad. It's horrible. And, but Nike, I'm going to say is more stay at home because people just kept on buying Nike. But I think it's up so much and it's so sensitive because it's up so much. It's such a high PE ratio that a rise in interest rates could actually hurt them. So I'm going to say there, stay at home, work from home. Procter & Gamble, consumer staples, stay at home, work from home, steady Eddie growth, somewhat similar to Johnson & Johnson and Merck. Salesforce is kind of sad. Maybe they should call it Sadforce. Okay. So Salesforce is kind of sad because that company should have done unbelievably well as a stock during the pandemic. They're trying to buy Slack for like $40 billion, and that took the wind out of the stock. It wasn't too long ago that Salesforce went from like 200 to 300 when they were added to the S&P 500. And ever since then, it's just backs off every day. And every time you think the stock is cheap, you buy it, it's $211, and it just goes down more. But I think of that now as a both play, reopening and stay at home, work from home, because no one is better at taking data, aggregating consumer data, and turning it over to a corporation and saying, these are the people you can market to. This is when you should market to them. This is what they want. They basically tell you what you need to know about your customers, about your sales force, and they track everything with technology. It's just an incredible company. So I'm going to say it's both. We're getting through this pretty quick. Travelers, reopening play. I like to say it's reopening play because it's a financial first and foremost. And, it's tough to say. They're a commercial insurer, so maybe a lot of commercial entities want to say their entities are worth less, so they want to pay less for insurance, and travelers could get dinged by that. But I still think it's a reopening play. United Healthcare, definitely work from home, stay at home. The thing they have going for them that could also make them a reopening play is as more people get jobs, they get health insurance through their company. That could also work in their favor. But United Health has been such a great consumer in this market. So I'm going to say United Health is both. Verizon, that to me is a work from home, stay at home. We depended on our AT&T, Verizon, or T-Mobile cell service, cable TV, Fios, whatever. And it's a steady company, and steady Eddie companies are more highly valued during a recession, during a shutdown, less so when the economy reopens. So I'm going to say they're stay at home, work from home. Visa is just both. And I think Visa is going to have a lot of announcements coming out because all these companies like PayPal, for example, are getting into crypto. And I think you kind of have to get into that. You can never have enough coffee. I'm not saying you as a consumer, as an investor, get into that. I think as a company, I think companies have to at least show that they're technologically savvy, and they have to almost in a way do something to tout crypto. But I think Visa it's tough to say. I'm going to give it both. They've helped. It's not that Visa has gone up so much during, from this before the pandemic to now. It's not that Visa has moved up so much. It's kind of the same. It's a little higher than it was, last February of 2020. But they hold their own. It's a steady grower, and it's more of a play on cash to plastic. And globally speaking, more and more consumers are using credit cards. Walgreens, work from home, stay at home. It's healthcare related. Yes, I know they have a retail store. The front end is retail, the back end is pharmacy. But I'm saying it's work from home, stay at home company. It's one of the best performing stocks this year in the Dow, by the way. Being up $3.62 definitely helps that one out. But work from home, stay at home. Walmart, I'm going to say, and a lot of people are going to disagree with this, but I think it's just a stay at home, work from home, economic shutdown play. That's the one where you went because it was one of the only stores that stayed open, them and Target. You went to those companies and Costco for everything you needed to get through the pandemic. Walmart is killing it in their, Walmart's killing it in their internet growth business. They're in their internet retail business. So Walmart is doing very well. They pushed all the right buttons. They pulled all the right levers. But now that people are going back into consumer discretionary, not just staples, that's why you're seeing companies like Macy's, for example, run big off its low. And Walmart's kind of, it's been steady-ish, but it hasn't been the growth stock lately. So I'm going to say stay at home, work from home. And Walt Disney, I'm going to give them a both. They're both. During the pandemic, Disney, so I'm going one at a time. Maybe I should have still been sharing my screen. I'll put myself back there one more time. Disney is both, because when the theme parks and the stores shut down and the movies shut down, people were like, oh, crap, what's Disney going to do now? And all of a sudden, they're like, we hit 70 million subscribers in Disney Plus. You know, like, I don't know, 3 months. It took Netflix years to do that. I mean, it's an easier environment to reach people because there's more broadband internet access today. But still, I think they've already surpassed 100 million subscribers. And now they're releasing their movies into Disney Plus for a fee. It's cheaper than going to the movies. And now that their theme parks are ready to open and the movie theaters, I'll tell you what, right now, as we speak, my son, a high schooler, he went to the movies. He's in a movie theater right now with his buddies going to the movies today. And that like blows my mind, because my kids haven't, you know, when you're a teenager in high school, going to the movies is part of what you do. So I'm really happy for him and his friends. And Disney, though, is both, because they really pivoted to conquer that subscription service, which is so richly valued by investors. And now their theme parks, movies, stores, etc., that comes back, their hotels. It's really remarkable. So I think Disney is both. So there you go, folks. I hope this helps you out. Now, it's tough to say where we go. I have my point of view. I could always be wrong. We could see much more inflation than we expected. The Federal Reserve might have to rush and raise interest rates sooner than we expected because they are perceived to have gotten behind the 8 ball. So that is the kind of thing that we need to consider. Okay. So I hear the music, which means it's time to go. And the reason I hear the music is because I hit the right button. All right. So I want to thank all of you for watching the show. We went through all 30 stocks. There are a few comments I'm going to take a look at. Rick is out there. Rick, my opinion, the IPO of the upcoming Coinbase IPO, I don't have an opinion on it. 3D tech stocks, I think 3D is pretty cool. I read an article about entire small towns and villages are being built with 3D technology. Like to see somebody make money in that space. Powdered metallurgy futures still look promising. I don't know. I'm not even familiar with it, to tell you the truth. I don't know. Industrial 3D printing stocks. I think these are great, but I don't know if these are stocks that you make money on or just like the fax machine. Nobody really made money from fax machines. Or is it something that you have to have? It's really tough to know. I'm not in any of those. GKN, don't know it. Mark, don't know it. Nickel titanium technology. Sounds good. Sounds expensive. Sounds like I'd like to get a Breitling watch made from nickel titanium. That would be cool. I don't know if that's such a thing or not, but nope, don't know it. The memory metal. I'll have to look into that. Dentists are investing into nickel titanium. Okay, for fillings, I guess, right? Ford U.S. nickels are 75% copper, 25% nickel, LOL. Okay, what do I do with all my pennies? Pennies are such a pain in the neck. All right, guys. So that's about it. I'll be back tomorrow. I thank you so much for watching. And who else is out there? Maddie, good to see you. All right. That's it. Mitch Goldberg signing off.